Today, we're talking about one of the most exciting parts about investing, which is valuation. We're going to try to understand what it means to buy a business at a great price. Let's find some value. One of the most widely taught concepts in university finance courses is the efficient market hypothesis. And what the efficient market hypothesis claims is that stock prices at any given point in time reflect all possible information. In other words, anything we can possibly know about a business is already priced into the stock whenever we look it up. The direct implication of the theory, then, is that it becomes extremely difficult, if not impossible, to consistently outperform the market. Now, the theory is very academic, but there is a certain element of truth to it. Markets are quite efficient because information spreads very quickly. But at the same time, the greatest investors in history, people like Warren Buffett, Charlie Munger, and Peter Lynch, they've always argued that markets are not perfectly efficient. In fact, Warren Buffett famously said that if markets were perfectly efficient, he'd be a bum on the street with a tin cup in his hand. And the reason he said it is this. Stocks are just businesses, and if stocks are just shares in businesses, then the price of stocks should ideally reflect the worth of the underlying business. But the thing is that market prices don't always reflect the true worth of businesses, and that's the main theme we're going to be talking about today. Before we get to that though, let's first talk about businesses and how we can think about their worth. Remember, a business is an asset, just like a house. In fact, a business is a collection of assets, physical assets, human capital, intellectual property, that together have the ability to generate profits over time. Because of that, just as we can estimate what a house might be worth, we can also attempt to estimate what a business might be worth. However, valuing a business is a little more difficult than valuing a house. The reason is that the value of a business depends a lot on how it will perform in the future. To put this into perspective, suppose I buy a gas station. The gas station has done very well over the past 10 years. But suppose it's located in a town with an aging population that is slowly declining. Over the next decade, many people expect the town to lose residents and economic activity. Even though the gas station has done well historically, its future prospects might not be very strong. Fewer people living in the town likely means fewer customers buying gas and other products. Because of that, the gas station may not be worth as much as its past performance might suggest. So notice what's happening here. The value of the business today depends on expectations about its future. That's why valuing companies is not a hard science. It depends on future expectations, and that varies widely from person to person. Two investors can look at the exact same business and come to very different conclusions about what its future looks like. That difference in expectations is one of the reasons why stock markets temporarily misprice companies. Most of the time, markets are efficient. But every once in a while, they become overly pessimistic or overly optimistic. When that happens, stocks temporarily diverge from what the business is actually worth. Warren Buffett has a great way of explaining this. He says that in the short run, stock markets are like voting machines, where prices move according to sentiment and popularity. However, in the long run, stock markets are like weighing machines, where eventually businesses are valued according to their true earning power. Now, a great example of this playing out in real life was Meta's stock price action at the end of 2022. In October 2022, Meta's stock fell dramatically, from around $380 per share to under $90, a decline of more than 70%. Investors became extremely pessimistic about the company. There were concerns about slowing advertising growth, competition from TikTok, and heavy spending on virtual reality and the metaverse. But if you looked at the underlying business, much of the core engine was still incredibly strong. Facebook, Instagram, and WhatsApp still had billions of users around the world and generated enormous cash flows. The long-term competitive advantages of the business had not suddenly disappeared overnight. Yet the market was pricing the company as if its future had been permanently damaged. Investors who focus on the underlying business rather than the short-term panic saw an opportunity. Over the following years, as Meta improved its profitability and investor sentiment shifted, the stock recovered dramatically. Another example occurred more recently, in April 2025. President Trump announced sweeping tariffs on many U.S. trading partners in what he called Liberation Day. The announcement created widespread fears of escalating trade wars and economic disruption. Global markets reacted very negatively, and many stocks sold off sharply in a short period of time. But for many individual companies, nothing about their core business operations had actually changed overnight. Their factories were still running, their products were still being sold, and their long-term competitive advantages remained intact. Yet the market reacted emotionally to macroeconomic fears, and many stocks declined significantly simply because investors became more fearful about their economic outlook. Situations like this are exactly the kinds of opportunities that great long-term investors try to take advantage of. If we can identify fantastic businesses that are financially resilient and have strong competitive moats, then we can try to be patient and wait for moments when markets become pessimistic. We saw these types of opportunities during the 2020 COVID crisis, during the 2008 financial crisis, and periodically during other moments of market panic. Those types of setups are perfect for us because they allow us to buy companies that are great at what we call a margin of safety, or simply at a discount, at prices that are far less than what we believe the businesses are actually worth. It's like going to your favorite clothing store on a big sale day and getting a great sweater or a pair of jeans or a nice t-shirt for 50% off. The product itself hasn't changed, it's just temporarily selling at a lower price. These sale days do happen in capital markets. They're situations that don't happen all the time, and sometimes we need to be patient for long periods. But when they do happen, the smart investor is the one who understands a few businesses very well and is ready to capitalize on the opportunity. Now, the margin of safety is important because if we buy stocks at a discount, we've reduced our exposure to the downside. At a discount, we believe the stock's price is unfairly depressed, and so we're expecting it to rebound back to its intrinsic value and continue compounding from there, because we also believe it to be a great business that has durable competitive advantage in the long run. Now, this strategy of buying great businesses at prices below their intrinsic worth is the foundation of value investing. It's the exact same strategy that the greatest long-term investors have used to consistently outperform the market. So the million-dollar question is this: how do we know what a business is actually worth? How can we calculate a fair price or an intrinsic value for a business? Well, there are various methods to do this, and that's what we're going to talk about in the next video. We're really looking forward to it, and we'll see you there.